Topic explains the role of external credit ratings in assessing the creditworthiness of borrowers and debt instruments within global financial markets. Credit rating agencies evaluate the likelihood that issuers such as corporations, governments, and financial institutions will meet their financial obligations on time. The most recognized agencies, including Moody's, Standard & Poor's, and Fitch, assign ratings ranging from high-grade investment quality to speculative or default status. These ratings provide investors with a standardized framework for comparing credit risk across issuers and securities. Financial institutions, regulators, and portfolio managers rely heavily on ratings when making lending, investment, capital allocation, and risk management decisions in increasingly complex markets. The topic emphasizes that external credit ratings influence borrowing costs, investment eligibility, and market confidence. Issuers with higher ratings typically enjoy lower financing costs because investors perceive them as less likely to default. Conversely, lower-rated issuers must offer higher yields to compensate investors for greater credit risk. Rating agencies evaluate numerous quantitative and qualitative factors, including leverage, profitability, cash flow stability, industry conditions, governance quality, and macroeconomic risks. Sovereign ratings additionally consider political stability, fiscal discipline, and economic growth prospects. Because ratings affect investor perceptions and regulatory treatment, changes in ratings can significantly impact market prices, liquidity conditions, and institutional investment strategies across financial markets. The topic also examines the limitations and criticisms associated with external credit ratings. Credit rating agencies have been criticized for reacting slowly to deteriorating market conditions and for failing to anticipate major financial crises. During periods of market stress, downgrades may occur only after asset values have already declined substantially, reducing the usefulness of ratings as forward-looking indicators. Conflicts of interest may also arise because issuers frequently pay agencies for rating services. Additionally, over-reliance on ratings can create systemic vulnerabilities when investors and institutions depend excessively on external opinions without conducting independent credit analysis. Consequently, regulators encourage firms to supplement ratings with internal risk assessments and broader analytical frameworks. Topic also focuses on rating changes and alternative approaches to measuring credit risk beyond traditional external ratings. Credit ratings are not static and may be upgraded or downgraded as economic conditions, financial performance, or issuer fundamentals change. Rating transitions are important because they influence bond prices, capital requirements, and portfolio valuations. Downgrades often increase borrowing costs and may trigger forced selling by institutions restricted to investment-grade securities. Credit spreads generally widen before formal downgrades occur because market participants anticipate deteriorating credit quality. Therefore, investors frequently monitor market-based indicators such as bond yields, equity prices, and credit default swap spreads to detect changing credit conditions earlier than rating agencies. The topic further discusses additional rating methods, including internal credit models and structural approaches to default risk estimation. Internal rating systems are commonly used by banks to evaluate borrowers based on proprietary scoring methodologies incorporating financial ratios, repayment history, industry outlooks, and macroeconomic variables. Structural models, such as the Merton model, view default risk as a function of a firm's asset value relative to its debt obligations. Reduced form models instead estimate default probabilities statistically using historical market data and observed credit events. These approaches provide more dynamic assessments of credit risk and may respond more quickly to changing market conditions than traditional agency ratings alone. The topic concludes by emphasizing the importance of integrating external ratings with broader credit risk management practices. While agency ratings remain valuable benchmarks for evaluating credit quality, they should not be viewed as complete or infallible measures of default risk. Financial institutions increasingly combine external ratings with market indicators, internal models, stress testing, and scenario analysis to develop more comprehensive assessments of credit exposure. Effective credit risk management requires continuous monitoring because borrower conditions can deteriorate rapidly during economic downturns or financial crises. By incorporating multiple perspectives and analytical tools, institutions improve decision-making, strengthen portfolio resilience, and better manage the evolving risks associated with lending and fixed-income investing.